My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to make you a little money. My job's not just entertain, but to educate, put everything in context. So call me at 1-800-743-CNBC. You can tweet me, Jim Cramer. Now, see, if you cut everyone's taxes, something that the stock market obviously loves, then sooner or later, you got to make up the lost tax receipts. But what if the Treasury doesn't have the money? Then just like everybody else, the government has to borrow to make up the difference. And it borrows by selling bonds, trillions and trillions of dollars worth of bonds. These tax cuts haven't even happened yet. But today we got the preemptive bill from the bond market. And this, we think, this entire rally. Dow only pulling back 382 points, S&P declining 0.29%, Nasdaq only dipping 0.09%. But could this be the beginning of an interest rate comeuppance, lest the country go broke? It's what a lot of people are thinking about. Perhaps we put the stock cart ahead of the bond horse. Let me explain. Now, stocks have been on a rampage ever since we learned that Donald Trump won the election. The rally's been uneven. Some of the gains have gone to mid-cap and small-cap stocks that bet on very fast deregulation. Now, while the president himself doesn't directly control the levers that can put a damper on business, under Biden, the agencies like the FTC, which regulates mergers, the Consumer Financial Protection Bureau, the Environmental Protection Agency, and the Federal Energy Regulatory Commission, among many others, have been pretty darn heavy-handed. It's been bad for the market, but now it's about to change. There are plenty of people who expect that corporate taxes, individual taxes, and capital gains taxes will be cut. Nobody's sure exactly where the cuts will come, but we all know that taxes in aggregate are going to go lower. If it's all like 2016 when Trump first became president, the wealthy will be the biggest beneficiaries. I don't know. And when rich people get more money, the theory goes they invest in stocks to create new businesses. Whether or not trickle-down economics works for the economy, I am telling you right now, it has always worked for the stock market. These positives have made for a very good one-week rolling bull market that included tech, small cap, mid cap, most important of all, the banks. That's the bullish cart, though, pulling mightily uphill, climbing the wall of worry. Today, though, we revisited that fractious and unruly horse, the bond market. And lots of stock buyers seem to have shown a bit of remorse once they got the bill, as interest rates spiked across all maturities. The focus when it comes to stocks is the benchmark 10-year Treasury note. That's the competition in the bogey. Jumped to 4.43%, up a dozen basis points. Now, sure, you can say, what's the difference? 4.31, 4.43, who cares? But when you look at the move, the size of the move, the speed of the move, you realize that the federal government's already borrowing trillions of dollars from the bond market, and that's before any Trump tax cuts. Consider it like a credit card that you might have in your wallet. They just raise your rates. It's not something that makes you want to spend more. I usually don't want to talk about it. It's really boring. Doesn't matter. I have to because it causes the stock market to go down. That's my bailiwick. Now, we all know that eventually there does need to be some sort of reckoning. Anybody can do the arithmetic of how much less the government will bring in with the tax cuts. Sure, though, there's a hope that growth spurred by lower tax rates will somehow result in higher tax receipts down the road, although that's never worked on any time frame that matters. Some people believe that Tesla's CEO Elon Musk, empowered by President Trump, he might find a way to trim a couple of $1 trillion from the deficit. They think he can dramatically cut the dead wood and fire the pointy-headed anti-growth bureaucrats. I'm not buying it. Every penny of the budget has a constituency, so spending costs, they cost you votes. Others think that tariffs can bring in lots of money, maybe several trillion, again, offsetting the loss in revenues from lower taxes. This theory makes almost no sense whatsoever, because tariffs can never add up to the lost revenues from lower taxes. That is just arithmetic, too. So we get a sobering reaction to the potential unfunded tax cuts from the bond market, making it impossible for the horse to push the cart up today. Lots of home builders, for instance, got clocked, as they should with higher rates. D.R. Horton, which caters to the less wealthy, saw its stock fall $5 or 3%. The drug stocks were annihilated. They tend to do poorly in an inflationary environment that brings about higher bond yields like we got today. Let me give you the best example, because you know it. Consider the stock of Home Depot. The Despot reported better than expected revenues, earnings, and same-store sales. They came out at 6 a.m. Stock quickly jumped from 408 and changed to 420. That's in that market that's the Wild West market. But then the bond market intruded, bringing the stock all the way down to 403. Now, it didn't help that management made some comments on the conference call about how well Home Depot can do when mortgage rates fall to 6%. Any close listener would realize that with long rates on the rise again, the opposite will happen. Plus, heaven forbid we get a hot consumer price index number tomorrow, because the one thing saving us from the bond market is the Federal Reserve. But the Fed can't keep cutting rates if inflation picks up, right? The Fed controls short rates, which tend to align themselves with home equity loans, vital to Home Depot's rehab and renovation business. Still, I like this company. And we told Investing Club members that we'd be buyers of Home Depot on weakness. We don't think the negativity is justified. We grabbed someone in the trust in the morning because we thought the results were just too good to ignore. To me, Home Depot is the single best stock to buy when the Fed's cutting rates. I think we got a gift when the stock took a header off today's bond market action. Once the despot's earnings get moving, it tends to really fly. And today's earnings show the momentum is now with the Home Depot bulls like me. Even if the stock only fell 5 points to 403, where it was right after the mortgage comment was made. If this gets below 400, I say, buy, buy, buy. Oh, and I'd be remiss not to mention Tesla. After days and days of rallying pretty strictly because CEO Elon Musk is tight with the president-elect, the stock took a breather today, falling 6%. Maybe it's a pause that refreshes. I sure wouldn't bet against Elon Musk here, but there are plenty of scalpers out there who bought Tesla the day after the election, and they aren't even sure how the company's doing. For them, this was a short-term Trump trade, and they sure as heck hit the eject button today. Sell, 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 sell. Of course, as is always the case, there are pockets of positivity that seem immune to the tug of the bond market, at least for most of the session. After showing immense love for the semiconductors, disdain for the software companies for most of the year, the game is reversed. The Adobes and ServiceNows and Microsoft soared today. Doesn't make a lot of sense, and we're getting worrisome parabolic moves in many of these stocks. Shopify, the e-commerce enabler, shot up 21% to a new high in response to big dividend quarter. And Live Nation Entertainment jumped nearly 5% in the wake of some great numbers. We're going to have the show. We're going to have that company on the show later. So is this the buyer's remorse really, or just profit taking in sync with the bond market? I think the Trump card isn't finished leading the Treasury horse. This could be a pause, though. Bottom line, if you believe we're about to get big tax cuts, remember that somebody eventually has to pay for the missing tax receipts. As boring as that is, even if that means the government borrows a lot more money, causing bond yields to spike. We can only hope the stock market goes back to ignoring long-term interest rates, or that those rates come back down in response to some benign inflation numbers. Otherwise, you got to expect more days like today. They're not fun, I know, but there's no free lunch on Wall Street. At least no buffet that I think's lasting. How about we go to Zach in Texas? Zach.
Hi, Mr. Cramer. Thank you for taking my call. I've been watching you with my family. I've been watching you with my family for almost 10 years since I graduated, and I learned so much from your show, and I'm an investment club member.
Oh, thank you so much. Don't forget our Thursday meeting. You know, I'm going to talk about how our stocks fit in with the Trump rally. So go right ahead.
Oh, yeah. I watch it every week, or listen to it every week.
Thank you.
Question. I bought my first tranche of these shares when the 50-day crossed the 200 for a golden cross, and I bought them for about $29 a share. They had good earnings, and it pays a 6% dividend. But ever since I bought them for the last 3 weeks, it continued to go down. So I bought more at 28, again at 27. It's now 26. Should I buy more or just hold what I have or get out? Especially since RFK might be the new health czar and he's bad for big pharma. The stock is Pfizer.
All right, this is a tough one. Look at the group, though. Merck just went through 100. And Zach, I got to tell you, AbbVie, this shocked me that AbbVie could fall from 207 right down to 171. Bristol Myers would be down a lot if it didn't have that schizophrenia drug. I would say that you've got to hold the course with Pfizer. It yields 6 and change, and I don't think that dividend is at all in jeopardy. But, boy, they better show some gains in CGen. I can tell you that. All right, today's action might just be a pause, but if the market doesn't go back to ignoring long-term interest rates, we can expect more days like today, even as unpleasant as they are. On Main Money tonight, Live Nation popped to a new all-time high today after earnings. Does the move set the stage for more growth ahead? I've got the CEO. Then could it be time for a breakout in the bond market? I'm going off the charts and putting an old Margaret Thatcher acronym to the test. And later, the restaurant brand behind Chili's has been soaring this year. I'm talking with Brinker's top brass about what the company is cooking up next. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
What's driving this incredible run in Live Nation Entertainment with its huge concert promotion business paired with Ticketmaster and a rapidly growing advertising unit? This past spring, the Justice Department sued to break up Live Nation on antitrust grounds because owning both the venues, like the recently renovated Brooklyn Paramount Theater in New York, and running the events while owning the #1 ticket-selling platform gives them maybe too much clout. And that kept a little in the stock. But starting a few months ago, this thing started catching fire, climbing almost 50% since early August, including a nearly $6 or 5% move today. But I think most of the recent move here was people betting on a Trump win and a more reasonable antitrust department. Earlier today, we had a chance to sit down with Michael Rapito. He's the president and CEO of Live Nation Entertainment. Take a look. Michael, we're at the legendary Paramount, which lay dormant for a long time. It's a gymnasium. You use this basically as a stake to be able to explain that Live Nation is huge and ready for you.
Right. Yes, we're proud. This has been dormant for 60 years. It was a gymnasium, one of the greatest music venues originally, Ella Fitzgerald, all the great jazz performers back in the day.
And my mom saw Frank here.
Your mom saw Frank. So when we saw this and it was all boarded up with a basketball court, we thought we got to bring this back to its original roots.
All right, it's a good metaphor for what you've done. Entrepreneurially, you have created an organization, it's Ticketmaster, it's the venues, that I am astounded at the growth. The quarter was incredible. What do you attribute the incredible surge in demand for tickets? What's it about?
You know, it's today this consumer is a new consumer. You know, when you and I grew up, we listened to, the top 10 and had a very limited music repertoire. Today, that 14-year-old has Spotify in his pocket around the world and knows every musician. So the amount of music available to the consumer today has just propelled this idea that they want to see the live show.
Now, you are, I think, almost like a drug company. I look at your pipeline, which tells me where the stock could go next year. Already you're way ahead for this year.
Yeah, it looks like 25 is going to be probably a record year. We're on sale right now with over 20 million tickets. Looks like a large stadium year next year. So we're excited. It's going to be a big year again.
Right. For those who don't know what Live Nation does, could you explain the process and how you've grown over time? Because when I first met you, the dream you had seemed difficult to realize.
Right. You know, we looked at live. The business had been focused on recorded for so many years. Live was kind of a second thought. I looked at it as a global business, the idea that concerts were local and that we could go around the world and kind of assemble this team now, 48 countries, 100 offices, and be that great partner for the artist who says, I want to go on tour. Who do I call? Live Nation can do it all for you.
I'm glad you mentioned partner for the artist. I was very perplexed by the Justice Department going after your company. Maybe wanted to break, you have Ticketmaster and you have Live Nation, but also really kind of focused on the idea that you have frustrated artists. I checked this before I talked with you. Most of them found this was fanciful. New administration comes in. You guys are on record as saying, hopefully you'll see a return of a more traditional antitrust approach. Not necessarily not adversarial, but kind of like, let's figure out what to do, guys. Instead, it was really pretty much jackboot.
Yeah, we're hopeful that there's a better someone to sit down with and think about, right. Can we find a solution? We think we've built a great business. As you said, when you talk to artists, we tend to be their best partner. Right. We work for them, low margin business, and we're proud of what we've been able to do for the artist.
Now, one thing that also seemed quizzical about the Justice Department position is that there are people who feel that you have caused ticket prices to go up. But in reality, as someone who has bought tickets, it's not you that is really the delta. It is the scalpers that cause the problem.
Yes, we live this all the time. You know, every Saturday on sale, that artist does the best job of finding what they can charge. They leave a lot of money on the table. That's the reality. The artist is worried about their fans, and we find it absolutely frustrating on those Saturday mornings when there's pages of secondary tickets for thousands of dollars. And fans are pissed off at that. They don't understand the system well enough to know what a scalper does versus the artist. So it is a frustration we have.
Okay, how is Ticketmaster doing?
Ticketmaster's, on a global basis, we think it's got an incredible runway ahead of it. It's a very U.S.-focused business for many years. We're now just expanded to Brazil, Latin America, more into Europe. So it's going to have an incredible global runway of expansion. In America, it's going to have a record Q4 because of the push around the concerts and the stadium business. So it's an incredible business and got a great runway.
How does data inform pricing? You guys are very sophisticated in trying to be able to figure out what the right price is.
Yes. Yeah, the challenge always is work with the artist. The artist wants to understand what's the best pricing. What people forget is these artists are like Super Bowls. They're traveling with
We're talking
25,
about
30.
About Swift. We're talking about Beyonce.
They're traveling with 30, 50 transport trucks, $10 million a week in running costs. So they've got to find that fine line on how do I make it affordable, but also how do I make sure I can pay all the bills as everything is increased. So any data we can give them through our database, our intelligence, to say, here's what you should price on a Tuesday in Pittsburgh. We give them all those options, and then they decide what's the best path for their band.
Excellent. Now, we are looking at an auditorium that I see has multiple bars. I know that sponsorships are also very important, and advertising. You have multiple streams of revenue away from just the tickets.
Yeah, we have a huge sponsorship division. We have over 1,000 brands that come and want to be part of the live experience. We kind of consider ourselves the NFL of music. If you're a brand and you want to touch this band tonight, you want to be part of this experience, a festival, global basis, we actually provide the best platform.
Now, talk about this post-election. There's been a rally. Some of it is obviously people feel the DOJ can go away, but there was a belief that you couldn't really have great numbers if you don't have a Taylor Swift year or you don't have a Beyonce year, but your model shows a little bit more resilience than that.
Yeah, we've had a lot of questions over the last months about consumer demand.
Right.
And we always put ourselves in a different category. It's a very scarce commodity. If you want to see Ben Folds tonight, who's playing here, you have to come tonight, whereas you may just delay your Disney trip. There's an urgency around that artist. So we're not seeing the pullback. We're just seeing as more artists are on the road, bigger artists are on the road, those consumers still go into that show top of their list.
Now, we know that ticket prices, from looking at the personal consumption expenditures, they did have a big blip up. Is there something post-COVID that made it so people just said, I have found another way to live my life. I want to go see experiential. Is that still holding true?
Yeah, 100%. We've been saying for the last 7-8 years, this experience economy was on the move.
Right.
Post-COVID, it absolutely skyrocketed, and we see now consumers spending more experiences versus products. We happen to be at the top of the poll with sports in experience spend, so we're getting the great gain from that shift.
And from all the people who want to go, what do you advise to someone, say, who wants a ticket to a good concert and is afraid that they may have to pay the scalpers? Can you come in early? You be the first in? I mean, what are you doing to help those people?
Right. I mean, the best thing that we love about our business is the consumer, or the artist is now the consumer best place to communicate. So most artists have incredible followings. They've got their own Instagram, their own website. So follow that artist. That artist is the one that's going to tell you where to go for the pre-sale, how to register in advance, how to be part of their community.
Now, talk to me about the venue, the places that you own, and how that has grown. I mean, obviously, you did all this work here. I mean, you're talking about this was not an easy place.
No.
There's millions and millions of dollars, but look at that.
Yeah, this was a few years and lots of workers. We just look on a global basis that when we put a show here tonight, it's obviously better for our business model. We're going to make sure that the food and beverage does well tonight, the hospitality. So any way that we can absolutely come into a market where there isn't a venue like this one or a white space around an arena, we think that there's a great opportunity for us.
Now, you probably know more than anybody else in the world about maybe some big tours, some artists to be coming on. Anything in the pipeline next year, you can give us a little leg, show us a little something, because there's got to be some big artists coming if you have these numbers already for next year.
Yeah, I think the next couple of weeks will be very exciting for fans. I think there'll be some good announcements and some good on sales that will propel next year. So we've already had this monster Oasis reunion tour. We're on sale this morning in Latin America. That'll sell out instantly. But we've got some more big news coming over the next few weeks.
One last question. When I met you many, many years ago, you had this dream. You were very passionate about it. What do you tell people who have a dream and may feel frustrated by others? Because what you had in mind was global and big, and you were neither at that time.
Yeah. I say to my team a lot, we have a really small to-do list and a big don't-do list. And I think what I've done well for the last 16, 17 years is everybody has an idea and pushing that on the don't-do list while we stayed focused on if there's a stage and there's an artist on a global basis, we want to be in that. So keeping focus has been the win. And
if you are a fan and watching this and there's something, we look at the schedule, you've got different ones every night, right? I mean, there's probably 3, 4 this weekend. How many do you have this weekend?
Live Nation somewhere has 100 and something shows a day somewhere in the world. So 48 countries. So we're very proud of what we're
Well,
doing.
congratulations about what you've accomplished. It's really quite exciting. That's Michael James, President and CEO of Live Nation Entertainment. I am glad I'm in the presence of someone who followed his dreams. Great work.
Thank you.
Coming up, with stocks hovering near record-breaking highs, Cramer's getting a technical take on a potential pause in the rally. Next.
Ever since the financial crisis, this market has belonged to TINA, Margaret Thatcher's old acronym for There Is No Alternative. Now, she was talking about free market capitalism when she said it. But in the last decade and a half, TINA meant there's no alternative to owning stocks. Basically, we had close to 2 decades of ultra-low interest rates, which meant you couldn't get much yield from the bond market. And when bonds don't give you much money, well, guess what? Money managers move their dollars into riskier assets like stocks. So from 2009 through 2021, there was no alternative. Stocks were the only game in town. TINA ruled the roost. But then a funny thing happened. When COVID hit and inflation started roaring, the Federal Reserve responded by rapidly raising interest rates. At one point, treasuries were paying from 4% to almost 6% on various parts of the yield curve. Normally, that would lure money away from the stock market into the lower risk bond market. We did see some of that, but by the late 2022, the stock market bottomed, averages never looked back. So now we're in a strange moment where stocks have had a tremendous multi-year run, with the latest leg coming as part of the Trump rally 2.0, even as treasury yields are still pretty darn high. Even though there is an alternative, money managers are still acting like we're living under TINA. The question is, how long can this dynamic last? You and I need to know this answer. To find one, we're going off the charts with the help of Carly Garner, a terrific technician. She's the co-founder of Carly Trading, author of Higher Probability Commodity Trading. As she sees it, traders are drunk on risk and addicted to chasing high returns without much awareness of what could happen to their money if something goes wrong. And in fairness, they're doing that because, well, for years it's been rewarded. Unfortunately, Garner's convinced that sooner or later this strategy will blow up in our faces. In fact, she believes we're headed for a new and very different TINA situation, except this time, rather than being no alternative for stocks, well, she thinks there'll be no alternative to owning treasuries. With the yield on the 10-year note back to 4.4%, as I talked about at the top of the show, Garner says you're getting paid now to wait. The 10-year isn't as sexy as a tech stock, a triple leverage ETF, but this is a question of risk-reward, and there's very little risk to owning treasuries unless you believe the U.S. government's going to collapse. I don't. At the same time, Garner points out that Warren Buffett's now actively raising cash by selling risk assets, so she's not alone here. Plus, unlike the first Trump rally back in 2016, which surprised Wall Street from the get-go, this time everybody knows exactly how the Trump trade's supposed to play out. Hardly anyone thought Trump would win 8 years ago, but this time around, he was the modest favorite going into Election Day. And we've already had a monster run since the results of the election. That's why Garner's concerned that the Trump rally could run out of steam before he even gets sworn in. So she's worried about stocks, like those with buyer's remorse, as I talked about at the top of the show. But she also sees opportunity in the bond market. So take a look at this monthly chart of the 30-year Treasury. Right now, Garner thinks that expectations for inflation created by Trump's proposed tariffs have been aggressively baked into bonds. It's now been 8 years since Trump won his first term. So by this point, we have a pretty good idea of how he operates in the office. Hey, I say think of it as the art of the deal. So let's look at the chart in the historical context. When Trump left office, the price of the 30-year was sky high, and the yield was super low at 2.5%. That was because the Federal Reserve was printing money in order to offset the damage from COVID. Before the pandemic, the yield on the 30-year peaked at 3.4%. Right now, the 30-year bond is priced at extremely low levels, nearly 4.6%, as bond traders are betting on both higher economic growth and higher inflation, two things that lead to higher yields. As Garner sees it, though, this is pretty extreme versus where the 30-year was trading during the last Trump administration. The price of the 30-year market has languished at discounted levels for longer than Garner originally expected, but she believes the long-term chart remains objectively positive. The relative strength index, right down here, RSI, okay, important momentum indicator, now trending higher, but it's very far from being overbought, even as the 30-year has been making lower lows. That tells her that bonds could be ready to rally in price, sending yields lower. How about the stock market side? All right, check out the monthly chart of the S&P 500 futures. This is what I know you're focused on. Given that we're looking at 4 years of deregulation, especially in antitrust, which means we'll start seeing lots of mergers again, it makes sense that stocks have roared. However, Garner points out that equity market valuations are near dot-com bubble heights. And in her view, much of the gains come from government spending and loose monetary policy. She's worried that the new administration may end up inheriting a stock market dumpster fire. Why? Because since 2018, the S&P's been making a series of dramatically higher highs, while the relative strength index has consistently made lower lows. That divergence has continued for years without any consequence. But sooner or later, Garner thinks we're going to get our comeuppance. That said, because the stock market tends to have a strong run into the end of the year, she still wouldn't be surprised to see the S&P make one last push towards 6170. We're at 5984 now, before any real selling kicks in. You might think, hey, let's just wait for that. I don't know. However, when you look at the support levels here, Garner believes that a healthy correction could easily push the S&P down to the mid-4,000s. And it maybe even 3,500 could be not out of the question if we get a serious slowdown. She's definitely not saying that decline is inevitable, but it's real risk, and that few investors seem to be taking seriously here. I know I haven't thought about it until I talked and read this piece. As Garner sees it, ever since the financial crisis, especially the pandemic, our stock market has been propped up by the Federal Reserve. Now, I don't totally agree with her. But it's true that we've had much easier monetary policy than we tended to have in previous decades. So she doesn't think that's sustainable. You need actual productivity growth to keep an economy humming over the long haul. You can't just keep printing money in the hope that everything will work out. Take a look at this chart of the Nikkei if you want to know how bad things can go. This is a benchmark Japanese index. It soared in the late 80s. Okay, it's bigger than ours at that point. But then it crashed in 1990, and it took Japan decades of negative interest rates before the Nikkei could eventually return to its old highs. That only happened earlier this year. Garner thinks we're seeing something similar in China, too, where no amount of government stimulus can seem to bring back the formerly rapid growth. Here's the bottom line. The charts as interpreted by Carly Garner suggest that the stock market might be getting overextended, while the bond market is potentially due for a rally. She's not saying stocks are about to collapse, but she does think you should focus a little more on the risk, a little less on the reward. Always a good posture, even if you disagree with her. Let's take some calls. Let's go to Brian in Pennsylvania. Brian.
Hey, Jim. Thanks for taking my call.
My pleasure, Brian. What's going on?
Jim, I've got some shares in Celsius Holdings that are just sitting on the sidelines during this rally. Now, I've made up my mind to cut my losses and switch over to Caterpillar. What do you think about that?
Celsius, there's something wrong with Celsius. While the company keeps talking a good game, all that happens is the stock keeps going lower and lower and lower. I think that you take the money out, buy some Caterpillar, and then maybe we get a big sell-off and you get another chance to buy more. Don't buy Caterpillar all at one price because it's just had a huge run off the election. And thank you for your confidence. The charts, as interpreted by Carly Garner, suggest that the stock market might be getting overextended, while the bond market may be due for a rally. I think it's good perspective to keep in mind. Much more Mad Money, including my exclusive with Brinker, fresh off another new high today. And could Elliott Stake and Honeywell be a bright spot for the stock, or should you be skeptical of this activist action? I'm telling you where I stand. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. What do we do with the stock of Brinker International, the parent company of Chili's and Maggiano's, after this incredible run? Well, we last spoke to the company in August after they reported a seemingly disappointing quarter and spent too much, so to speak, and the stock plunged 10% in a single day. I told you the sell-off was a huge mistake and the stock was a buy. Sure enough, since then, Brinker's stock has rallied 89%. Can it keep climbing? Let's check in with Kevin Hochman. He's the president and CEO of Brinker International to get a better sense of where his company's headed. Mr. Hochman, welcome back to Mad Money.
Hey, Jim. Thanks for having me on the show again.
Oh, I'm thrilled that you're here, Kevin. I want people to understand that in the business that you're in, it isn't like that the stock stops going up because you've stopped innovating. What I see you doing is every time I talk to you, there's innovation, and it's important innovation. So the idea that suddenly it's over at Brinker seems almost fatuous.
Yeah, Jim, it's funny. I was telling my own team just earlier today that more of our changes are ahead of us than are behind us. So there is so much more to do as part of this turnaround story. It's still about craveable food with amazing service in a fun and friendly atmosphere. And we've made some amazing strides in the last 2 years, but there's so much more ahead of us. And I think the innovation that you're going to see both on the service and the food side in the next few years is going to be mind-blowing, and it's going to continue this run that we're on.
How can you do it on the service side? I know you increased the spend on service already. People who are the analysts who are clueless didn't understand that if you did that, it could actually result in more revenue. It clearly did. So would you be adding even more people to get it so that things are really fast?
Well, I don't know necessarily we need to do that. First of all, let me just say, I think the analysts are all really smart. I learned a ton from them,
me
both
too.
the Bears and the Bulls. So
me too.
I got to say that.
Fabulous.
So, we're just getting started on this. So we've eliminated about a quarter of our menu, right? We're focusing what we call the core four. Now I'm calling it the 5 to drive, given the triple dipper results that we've had. and focusing on making sure that those are the best possible items that we can have in categories that Americans eat and drink and think a lot about when they go out to dinner, right? Well, we've got a lot more ahead of us. So think about the improvements that we can make on appetizers, the improvements that we can make on other parts of our menu, the improvements that we can make on making sure that we continue to elevate our service levels. Because at the end of the day, that's what's winning right now. Yeah, we have unbeatable value with our $10.99 3 for Me. But when guests come in, they're getting abundant food, craveable food, and they're having it fast and friendly atmosphere. And we're doing it consistently. And that's why we're winning right now in the marketplace.
All right, so let people understand the actual empirical evidence. The Triple Dipper, 11% of Chili's business sales increased 70% year over year.
Yeah, so we've got kind of a two-fang marketing plan right now. So everybody's very familiar with the 3 for Me. That is appealing to all guests. Lo and behold, Jim, all guests of all income levels love a great value that's served consistently with delicious food. So that's been working for the entire universe of our guests. And then we've got this thing, the Triple Dipper, that really we've activated in social media. We started in about March, and we saw a nice run behind that campaign. And now we've innovated on it with the Nashville Hot mozzarella stick, which is also in that Triple Dipper, and that's exploded it even more. And that's why you've seen that 70% growth. And what we're finding is it's bringing a younger guest in. They like to eat more experiential foods. They like having multiple dips. They like to be able to customize. And that's what that Triple Dipper is doing for them. And the great news on that is it's not the cheapest thing on the menu. It's something, but it's a great value given all the food that you get.
One of the things that you've taught me that I think a lot of people need to understand is it's not necessarily the value that they want. It's the value that you have, because the actual numbers for 3 for Me, they're not necessarily accessing the real cheapest. They're just happy that you're giving them a bargain.
Yeah, here's at the end of the day, like customers, they don't want to do a lot of thinking about, where they need to go. They don't want to have an app or come a certain time of day. They're looking for everyday value. They're looking for abundance, and most importantly, looking for delicious, craveable food. And that's what we're offering. In our $10.99 tier, we've got 2 amazing hamburgers, including our Old Timer with Cheese, our best-selling hamburger of all time. And we've got a great chicken sandwich, which is, I think, probably the best on the market also. That's also at $10.99. And so, that guests can come in and they're not going to get something that's, a small mover or something they're not interested in. They're getting things that are right down the middle. They're having a great experience. And then we're finding they're coming back. People that eat the 3 for Me, not only do they spend more at Chili's each year, but they come back more frequently. And that's what we're looking for, sustainable growth over time.
Now, you did say that you felt commodity inflation would be up low single digit. Can you explain to our viewers why things do keep going up and why it's just kind of part of the territory, and whether it's always been like that?
Yeah, well, it hasn't always been like that. Obviously, there's lots of inputs that go into food costs. Wage rates certainly is a big part of that, right? Because, wages pretty much touch everything. And then we also see other costs that are, hit the restaurant industry. And, we've done a pretty good job being able to manage those costs down, as well as keep our prices low, and really focus on driving, guest counts. And that's what's, created that kind of financial windfall that we're seeing in the business, a much healthier balance sheet, and then more growth to come. So, I think as long as you focus on things that are important, which is guest counts, keeping things tight, making sure that we have a nice tight menu, you can manage through those things.
And in terms of things that are important, how about Veterans Day for your firm yesterday?
Oh my goodness, this is incredible. So, Veterans Day for our teams is really it's like everybody that's, available has to come to the restaurant and work, including our executives are out, in the restaurants helping the teams. We served over 330,000 free meals to veterans yesterday, over $4 million worth of food. And it's just fun for everybody. We're recognizing, our great veterans. They come and we're making them feel special, just like we do all guests. But it's a special, special day for our team members because it allows them to show up what they do best, which is making guests feel special.
Well, I'm so glad you got to bring that up. We got to talk about that. Next time we will talk about the turn Maggiano's. We didn't get a chance to do it today, so you'll have to come back and tell us how that just seems to be like year one that it was for Chili's is Maggiano's. I think that'll be a great thing to talk about. Kevin Hochman, President and CEO of Brinker International. I love you on the show. Thank you.
Hey, thanks so much, Jim.
Absolutely. Mad Money's back at the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
One of Mad Money's most important traditions is saluting our nation's veterans and service members. On Friday, I had the privilege of welcoming West Point cadets to the floor of the stock exchange. And tonight, I'm talking with veterans from across the country to answer their investing questions. And now it is time for a very special salute to service lightning round on Mad Money. And that's where I take calls from veterans, rapid fire. You say the name of stock, I tell you about advice, also just go to another call, stock questions that time. My staff prepares graphics on the fly. We play the sound. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Cramer's Mad Money. Let's go to Tim in Texas. Tim.
Hey, the demand for power plants and data centers could boost natural gas. The yield is 7.5%. Your thoughts on energy transfer right here in my hometown of Dallas, Texas, the Dallas Cowboys.
Well, I just came back from Dallas. I want to salute your service. I want to thank you. And I want to tell you to bye, E.T. Let's go to Buck in Arkansas. Buck.
Cramer, thanks for your continued support of our military and for taking my call.
Of course. What's going on, friend?
Hey, you've educated, taught, and entertained me for well over a decade, resulting in a much earlier retirement than I'd planned. Thanks so much.
I love it. I love it. Thank you.
Hey, I've been riding the wave of Cramer Fave T-Mobile since you first recommended it over 100 points ago. I've heard you continue to sing its praises on Squawk on the Street, as well as your interview with CEO Mike Sievert last month. It also hit an all-time high yesterday. My question is, do you think it's time to take some off the table or just continue to enjoy the ride?
Buck, I think first, thank you for your service, and second, let it ride. You know, I think it's a winner. I'm trying to get people to stay in great situations, not trade around them. Great job. Stephen in Pennsylvania. Stephen.
Yes, booyah, Mr. Cramer. I want to thank you and your staff for all that you do to honor us veterans and all that you do for individual investors. Thank you.
Hoo-ha. Thank you. Thank you for saying that. I hope I don't let you down.
My stock in question tonight with the recent expansion of 3 Mile Island, Constellation Energy. Is it a good buy now? CEG.
I think it still works higher. I think that the issue here is data centers is using too much energy. They've got a solution. I've liked them for a long time. Let's go to Purry in Louisiana. Purry.
Hey, Jim, what's going on?
Not much. How about you? You tell me.
Oh, okay. First, before we start off, can you give a Bayou Bingo Booyah and a Happy Veterans Day to all the warriors from 3rd Infantry Battalion, 2nd Brigade, 3rd Infantry Division, home of the dog-faced soldiers?
Holy cow, booyah to the dog-faced soldiers of the 3rd ID. What a terrific, terrific division that is. I remember my dad telling me that's a keeper division. Let's go to work. How can I help?
Okay, what should we do with IBM now that Trump is in office?
Well, I think we can hold it. I think we can hold it. Now, my old friend and business partner, Stephanie Link, actually was saying that maybe this is the time to actually buy more IBM today. I'm not going to go against her. She's too smart. Let's go with her judgment. Let's go with Michael in Massachusetts, please. Michael.
Hey, Jim, thanks for taking the time to speak with this veteran.
Of course, Michael.
I have a question regarding Snowflake. With Frank Slootman retiring and naming success with some AI experience, which, by the way, Frank believes will benefit Snowflake, do you think Snowflake has a viable product moving forward?
Boy, it's a tough question. And I've got to tell you, first, I want to thank you for your service, Michael. Here's my problem. I think that they are up against, I think their margins are going to go down. I think they have a lot of companies that are up against them. Ramaswamy's trying to do a good job. Frank Slootman was Frank Slootman was just a tough guy. I don't know if this situation is too tough right now. I am not recommending the stock. I'd like to go to Monica in Minnesota. Monica.
Hey, Jim. How are you?
I am good, Monica. How about you?
Good, thanks. I want to start with a shout out to the 353rd Transportation Company out of Buffalo, Minnesota. Great
Done.
Team. Yeah. I want to make sure I got that out there.
Absolutely. That's why we have you on. We want people to do that. We have plenty of time to talk stocks, but this is what really matters. So how can I help?
Yeah, that's right. Hey, I've been looking at Intuitive Surgical for actually about a little over a year now, and I keep thinking that I missed my chance to buy in here. There's a ton of, I believe there's a lot of market potential there, but their stock price, their P/E ratio is almost to 90. And I'm just wondering what you are thinking about. Would this still be a good buy?
Okay, so Monica, here's what you're going to do. Intuitive Surgical is a fantastic company with an expensive stock. I want you to buy a little tomorrow and then wait literally for down 10 and then buy a little, get a full position by the time it goes down 50, and you and I will do very well with ISRG. And thank you to everyone. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
Tonight, I come to praise activist investors, not bury them. For the longest time, I actually accepted the conventional wisdom that most activists were basically bandits. They bought stock, put pressure on management, and then hoped to catch a quick pop when the companies in question cried uncle. In recent years, though, you know what? I've begun seeing activists in a new light. Take Elliott Management, which I think is the most rigorous activist firm out there. This morning, Elliott revealed that it's taken a $5 billion position in Honeywell. That's the largest activist stake I can recall. They're urging the company break up into two divisions, aerospace and automation, which they argue could yield gains of 51 to 75%. Oh, what a monumental win that would be. And Honeywell can make it to happen simply with the stroke of a pen. By the way, I agree with Elliott. This is a terrific breakup candidate. Now, we've been big fans of Honeywell from my charitable trust for a long time. We brought it in part because the stock was trading at what we regarded as a conglomerate discount. The company was unwieldy, needlessly complicated. These days, Wall Street prefers smaller, more straightforward, nimble businesses that are easy to get your head around. Not that long ago, Honeywell decided to spin off its legacy chemicals business, focus on the company's three megatrends: aerospace, automation, and the energy transition. I applauded that move because it simplified the group of disparate businesses. At the same time, the company told us earnings would come in at the high end of their forecast. And that's why we told CNBC Investing Club members that we were encouraged by the tone of their comments. We figured that a beat and raise quarter, the holy grail of send stocks higher, was in the offing. But we were wrong. Soon after Honeywell disappointed on sales, lowered its outlook, its stock got crushed. As Elliott's letter details, quote, Honeywell's shares price has declined after each of its last 6 quarters, with 3 of these events ranking among Honeywell's 4 largest negative earnings reactions in the last 15 years, end quote. The culprit. Elliott claims that this underperformance is, quote, a direct result of a suboptimal corporate structure that has led to inconsistent operational execution, a diversified portfolio beset with numerous challenges, and the lack of a cohesive investor narrative, end quote. So if Honeywell breaks itself up into an aerospace play and automation play, you'll get a simplified two-company solution that will make the resulting business much easier to manage. I think that's undeniable. Plus, as Elliott points out, this market thirsts for pure-play aerospace company. Honeywell fits the bill perfectly. Their aerospace division dominates the cockpit for both Boeing and Airbus, both of them. That's why I welcome Elliott's intervention. We've been extremely aggrieved by Honeywell because the company lies smack in the middle of so many megatrends, but unlike its peers, it just can't seem to get its act together. And that's why I've been selling down the position for the charitable trust. Until this morning, that is. We've pretty much given up on Honeywell because of its endless missteps and excuses. At our club meeting on Thursday coming up, we intended to talk about why we were dumping the stock after a long period of frustration. But now Elliott's come along with a great plan that allows for better execution. With the smartest activist hedge fund willing to get his hands dirty, we're going to keep the rest of our Honeywell position, betting that Elliott will be able to unlock value here. Suddenly, this poorly run company has a potentially immense source of upside, as long as management takes the word of the activists rather than trying to fight them. I'd like to say, as always, a bull market summary. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.